Hey, what is up, guys, and welcome back to another episode of the Growth Stock Investing Challenge. I believe this is episode 5 of this series. The growth portfolio currently sits at a valuation of $1,839, which is down to almost $48 just today alone, which continues the trend we've seen over the last several weeks of just market sell-off. Really, the whole market has been pretty poor. But for last week, we're down about $102. For the month, we're down about $172. And for the quarter, we're down about $183. So this portfolio just continues to not be profitable. In fact, all time since I've opened it on December 14th of last year, we're down about $104. So this just really continues the trend that I've talked about the last several weeks of growth stocks just not really performing very well for a number of reasons. But this is really reflective of the entire market being down, which is usually when growth stocks are hurt the worst. Usually whenever more safe and defensive stocks are even selling off, growth stocks are going to be selling off at a much higher level. That's why these high beta stocks usually do worse when the market sells off, but also do better when the market is gaining. So there's kind of a little bit of give and take there. So really not too much activity in this portfolio this week. I did make my usual weekly deposit just to kind of dollar cost average my way into some of these positions. I put $25 in, let it auto invest like I always do, and it went towards Teladoc Health, PayPal, DraftKings, Lemonade, and Amazon. I believe out of these 5 positions, I'm only up on DraftKings, and that's just barely breaking even. I think I'm almost even on Amazon. But the rest of these are dollar cost averaging my positions that I am down on. If we go over to my holdings tab, we can kind of see a little bit more in depth that, there's a lot of red here. I have done well on positions like Tesla and Salesforce, but the rest are pretty deeply in the red, like Lemonade, Teladoc Health, Roku. These are all companies that I still have high conviction in, especially these top ones: PayPal, Roku, DraftKings, Activision, Amazon, Salesforce, and Tesla. These are my highest conviction in this portfolio. Academy, Teladoc are also fairly high. Lemonade is one I'm sort of worried about, but I still continue to hold it and buy more because I think there is a high potential for the stock if it can ever kind of get its feet under it. It is still a recently IPO'd stock as of just over a year ago. So it'll be interesting to see what it can do over the next year or two, especially if Lemonade can become a long-term profitable company in the insurance space. But I did want to focus the bulk of the episode talking about my view of different Chinese stocks, and specifically Alibaba, which I know is a favorite of a lot of YouTubers. It's never been a stock I've ever owned or plan to own. That's really for a number of reasons. But Alibaba has been a pretty poor performing stock over last year. It's currently at $138.72. It's down almost 4% today. But over last year, it's down over 50% from its highs. If you look at the 52-week range here, it is on the extreme low end of that. It was as high as $319.32, but for several reasons, it has just plummeted, mostly external to the company, but mostly it's due to the Chinese U.S. relations between our two governments. This has kind of caused some concerns for delisting and other things that the SEC could do to kind of hold Chinese companies and Chinese stocks in check, and also because of the Chinese Communist Party's increasing influence over these Chinese stocks and Chinese companies. That has also kind of caused some concern on Wall Street, and it's kind of caused a lot of investors to lose confidence, which has caused this massive sell-off that we've seen over the last year. If you are a little bit more of a risk-tolerant investor, I think Alibaba actually probably is a really good value play right now, especially if you're just looking strictly at the company and at their fundamentals. Their forward PE ratio is about 15 to 16, which is really, really low for a company of this size and with what they do. If you're actually not familiar with what Alibaba is or what they do, most people just kind of compare it as the Chinese Amazon. and that's actually a pretty fair comparison since they do a lot of the same things. They're pretty heavy into the retail space, but they also do a lot of things with tech and some cloud computing, or at least they're working on that. But mostly they pretty much are a large scale online retailer, so like Amazon. Um, I don't plan to invest in Alibaba at least anytime soon because of those concerns I have that are external to the company. If you look just at their financials, I mean, there's a lot to like here with increasing revenues, generally increasing operating income, all things you like to see out of a growing company. They've managed to keep their expenses and other things in check as well. So, again, these are all very, very positives if you're looking strictly from a fundamental basis of the company. Uh, but there is some concern to be had there. I mean, this is shared by pretty much all Chinese companies. So it's not just limited to Alibaba of why I'm not investing in them. It's just for these different reasons, namely the CCP's increasing influence. It's just not really something I want to be a part of, especially considering some of China's practices in their country and their view on trade and things. It's just not something I'm very fond of. But if you are an investor who doesn't really look into those kind of things and just kind of turns a blind eye, then definitely Alibaba could be a really good value play, as well as some other Chinese investments out there. But it is definitely something I will not be putting money into. So if you are a Alibaba investor, then well, I would recommend definitely holding it and probably buying more. But if you are kind of staying on the sidelines and considering getting in, this might be a good time to do so. If we kind of look at their interactive chart on Yahoo Finance, we can see that we're about to kind of cross over here on the 5-year chart. And if you look at the year to date, we already crossed over back in February. So seen a little bit of a death cross that just really hasn't come back since. It's actually, I kind of thought over the summer maybe Alibaba might bounce back off this 200 range, but it has actually since dropped even lower, all the way down to about a 140, which is a bit surprising. But I didn't really expect it to drop this much. It's just kind of been one of those companies I've kept an eye on, even though I'm not invested with it, which I'm just not going to do it anytime soon. But again, if you are looking at it, I would recommend maybe jumping in around this point. It's possible this still isn't the floor yet, but I can't imagine a company like Alibaba going much lower because again, the fundamentals are there, and it is a pretty good company. As of a year ago, it was one of the largest in the world. Now I think its market cap is around 350 billion, 360 billion, I want to say. So that's a little bit about Alibaba. Kind of check in on what the markets are doing. Look at what the VIX is. VIX is actually up about almost 14% today, which is a little concerning. If you're not really sure what the VIX is, that's basically the volatility index that looks at investor sentiment on the market, kind of sees what investors are doing. Basically, this is inversed with how the markets perform. So if the major indices are down, then expect the VIX to be up. But if the indices are up, then expect the VIX to be down. So we're seeing quite a lot of volatility today, which is again a continuation of what we've seen over the last month. Again, the VIX is way up over the last September. So that's definitely something to keep an eye on. That clearly investors are getting a little bit more anxious, and that's kind of why we've seen the broad market sell-off. All of the major indices are down more than 1%. Actually, the Nasdaq's kind of getting pummeled, down over 2% today. So that'll be interesting to see. But again, it is early in the trading session, so maybe this afternoon will be a little bit better, or maybe it'll just be another bad week. But one thing to remember if you are an investor, that September and October are some of the worst months of the year, but generally November and December are some of the best months of the year. So I wouldn't get too anxious if you're an investor. And if you are a long-term investor, now might be a great time to do some dollar cost averaging. That's just important to remember, especially in times like these. So that's going to pretty well wrap things up for this video. If you guys did enjoy it, go ahead and drop a like, as well as let me know in the comments what your view of Chinese companies is, specifically with Alibaba. Let me know if you're invested and what your general thoughts are. It's entirely possible I'm really missing something here, but again, feel free to share those in the comments. So yeah, I'll make my dividend portfolio update video on Wednesday, and I will catch you guys then.